Welcome to Finantax Clips. Today we delve into the fascinating world of the Federal Reserve. Often referred to as the Fed, this institution is much more than a mere financial entity. Established in the year 1913, the Federal Reserve was born out of a need to stabilize and regulate the nation's monetary and financial systems. Its primary purpose: to keep the U.S. economy on an even keel by influencing money and credit conditions in pursuit of full employment and stable prices. Now you might be wondering, why is a central banking system so crucial? Well, imagine steering a massive ship without a captain. A central bank like the Fed acts as that captain, steering the economy away from potential hazards and towards prosperous shores. So the Federal Reserve isn't just a building with a fancy name. It's the cornerstone of the U.S. economy. The Federal Reserve isn't just a name on a dollar bill, it plays a crucial role in our everyday lives. Let's dive deeper into the Federal Reserve's role in our economy. First, it acts as a regulator for banks. It ensures that these financial institutions are following legal guidelines and are operating in a secure, responsible manner. This function is vital in maintaining trust in our banking system, as it helps to prevent situations like bank runs or financial crises. Second, the Federal Reserve manages the country's money supply. This might sound like a daunting task, but essentially it involves making decisions about interest rates and lending activity to control how much money is flowing in our economy. When the economy is booming, the Federal Reserve might increase interest rates to cool things down a bit. On the other hand, during economic downturns, it might lower interest rates to stimulate spending and investment. This process is known as monetary policy, and it's a critical tool in promoting economic stability and growth. Finally, the Federal Reserve acts as the government's bank. It handles the U.S. Treasury's payments, sells government securities, and conducts other financial operations. This role makes the Federal Reserve a crucial player in managing the country's debt and influencing global financial markets. So, you see, the Federal Reserve isn't some abstract entity lurking in the background of our economy. It's an active participant, a sort of financial puppet master, pulling strings to keep our economic show running smoothly. It's involved in everything from the rate of your car loan to how much money is in circulation to the financial practices of your local bank. And let's not forget its role in managing the country's debt. The decisions it makes have ripple effects throughout the global economy, influencing not only how much your country owes, but also how other countries interact with it financially. Thus, the Federal Reserve has a hand in everything from your car loan interest rate to how much your country owes. The Federal Reserve wields a powerful tool: monetary policy. Now, what exactly does that mean? Well, let's break it down. Monetary policy is like the steering wheel of a car, guiding the economy down the road. The Federal Reserve, or the Fed as it's often called, uses this policy to influence the direction of the economy. It's a way to manage the amount of money flowing through the market, affecting things like interest rates and inflation. So, let's talk about interest rates. These are essentially the price of borrowing money. The Fed can adjust these rates, making it either cheaper or more costly to borrow. When the Fed lowers interest rates, it encourages businesses and individuals to borrow and spend more. This stimulates economic growth. On the other hand, when the Fed raises interest rates, it becomes more expensive to borrow money. This discourages excessive spending and helps keep the economy from overheating. Now let's move on to inflation. Inflation is the rate at which the general level of prices for goods and services is rising. A little bit of inflation is healthy for the economy. It encourages spending and investment. But too much inflation can erode purchasing power and create economic instability. The Fed uses monetary policy to keep inflation in check, aiming for a sweet spot of around 2% per year. The Fed can adjust the money supply too. When it wants to stimulate the economy, it increases the money supply, making more cash available for businesses and individuals. When the economy is heating up too much, it reduces the money supply to cool things down. So, in essence, the Fed uses monetary policy to maintain a balance in the economy. It's like a thermostat, adjusting the heat or the coolness to maintain a comfortable temperature. Through monetary policy, the Federal Reserve can turn the economy's dials, heating it up or cooling it down as necessary. And that, folks, is the power of the Fed in the palm of its hand. Recessions are economic downturns that can have devastating effects, but the Federal Reserve has tools to combat them. Let's dive into how the Federal Reserve, often referred to as the Fed, uses its powers to mitigate the effects of recessions. The Fed can influence the economy in several ways, primarily through monetary policy. This policy involves the manipulation of interest rates and the money supply to control inflation and stabilize the economy. When the economy is heading towards a recession, the Fed typically steps in by lowering interest rates. This action encourages borrowing, which in turn stimulates spending and investment. By increasing the money supply, the Fed can also stimulate economic growth. Essentially, the Fed's actions aim to boost consumer confidence and business investment, which are critical for economic recovery. Now, we can't talk about the Fed's role in combating recessions without mentioning some past instances where it has stepped in to stabilize the economy. One notable example is the financial crisis of 2008. The Fed slashed interest rates to near zero and implemented a series of unconventional measures, such as quantitative easing, to inject money into the economy. These actions helped to stabilize financial markets and prevent a complete economic collapse. Another example is the response to the economic downturn caused by the COVID-19 pandemic. The Fed acted swiftly, again cutting interest rates to near zero, providing loans to businesses and governments, and buying massive quantities of government and corporate bonds. These actions helped to mitigate the economic fallout from the pandemic and set the stage for recovery. While the Fed's actions during recessions are not without criticism, it's hard to deny the critical role it plays in bolstering the economy during tough times. Its interventions have prevented more severe economic contractions and helped to shorten the duration of recessions. Therefore, the Federal Reserve plays a key role in shielding the U.S. economy from the full brunt of recessions. So, the next time you hear about the Fed making moves in response to economic conditions, remember that it's all part of their broader mission to maintain economic stability. And that's a mission we can all get behind. While the Federal Reserve has a significant role in the economy, it's not without its critics. And indeed, there are many. Let's delve into some of the common criticisms that you'll often hear. First, there's the criticism about the Fed's immense power and influence over the U.S. economy. Critics argue that the Federal Reserve, by controlling the money supply and setting interest rates, essentially has the power to create booms and busts. They contend that such power in the hands of a select few can lead to economic volatility and even potential misuse. Then, there's the argument about the lack of transparency. Critics assert that the Federal Reserve operates with a degree of secrecy that makes it difficult for the public and even policymakers to fully understand its actions. They argue that more openness about its decision-making processes could lead to better outcomes and increased public trust. Another common criticism is the Fed's response to economic crises. Some argue that the Federal Reserve's measures during crises, such as quantitative easing or lowering interest rates, can lead to inflation or asset bubbles. They believe that these moves might provide short-term relief, but could pose long-term risk to the economy. Moreover, there are those who question the Fed's dual mandate of maintaining stable prices and full employment. Critics argue that these objectives can sometimes be at odds with each other, leading to policy decisions that favor one at the expense of the other. They suggest that the Federal Reserve should focus solely on price stability to avoid these potential conflicts. And lastly, some critics point out the potential for political influence in the Federal Reserve's operations. They express concern that political pressure could compromise the Fed's independence, leading to decisions that are more about political expediency than sound economic policy. These criticisms remind us that the Federal Reserve, while powerful, is not infallible. Every institution has its strengths and weaknesses, and the Federal Reserve is no exception. As we continue to navigate our economic landscape, it's important to keep these criticisms in mind and to remember that the ultimate goal is a stable and prosperous economy for all. The Federal Reserve, like all institutions, must adapt to a changing world. As we peer into the crystal ball of the future, several challenges come into view for the Federal Reserve. One such challenge is the rise of digital currencies. Bitcoin, Ethereum, and their peers have exploded onto the scene, and their impact on the global financial system is undeniable. The Federal Reserve will need to find a way to incorporate these digital currencies into its policies, or risk being left behind by this new technological revolution. Then, there's the shifting global economic landscape. Countries that were once considered developing are now major players on the world stage. This shift in economic power presents both opportunities and challenges for the Federal Reserve. It could mean new markets for American goods, but it could also mean increased competition and volatility. The Federal Reserve will need to navigate these waters with care, ensuring that American interests are protected while also fostering international cooperation. Changes in federal policy also pose a challenge for the Federal Reserve. The relationship between the Federal Reserve and the federal government is a delicate one. Changes in fiscal policy can have a significant impact on the Federal Reserve's ability to manage the economy. For example, large deficits can push up interest rates, making it more difficult for the Federal Reserve to stimulate the economy in times of recession. The Federal Reserve will need to work closely with the government to ensure that fiscal and monetary policy are working in tandem, not at cross purposes. The future of the Federal Reserve is not set in stone. It will be shaped by the decisions it makes in response to these and other challenges. But one thing is certain: the Federal Reserve will continue to play a crucial role in the U.S. economy. It will continue to be the steward of our financial system, the guardian of our monetary policy, and the first line of defense against economic downturns. As we move forward, the Federal Reserve will continue to be a vital player in the U.S. economy. So, we've taken a journey through the world of the Federal Reserve, from its role in the economy to its future challenges. We've explored how this mighty institution, often behind the scenes, steers the U.S. economy. From setting monetary policy to managing inflation and interest rates, the Federal Reserve has a hand in almost every aspect of our financial lives. We've also delved into the Fed's role in preventing and managing recessions, using a mix of tools and strategies to keep the economy on an even keel. Amid the praises, we've addressed criticisms, acknowledging that, like any institution, the Federal Reserve is not without its flaws. Yet, its importance in our economy is undeniable. Looking ahead, we've examined the future challenges the Federal Reserve might face and the possible solutions. Each step of the way, we've seen how the Federal Reserve is saving the U.S. economy from recession. Thank you for joining us on this journey. Remember to subscribe and share Finance clips for more insightful content. See you next time.